All right, let's jump right in. So, whether you're dreaming of starting a business, looking at real estate, or just trying to understand the stock market, there's a term you've got to know: depreciation. Now, I know it sounds super technical, like something only accountants care about, but stick with me here. It's actually one of the most powerful tools a business has in its toolkit. So, let's get into it. Okay, so the core idea is actually really simple. Just picture a brand new pair of shoes. When they're fresh out of the box, they look amazing, they're perfect, but the more you wear them, they get scuffed up, the soles wear down, they just aren't worth as much as they were on day one. Well, it's pretty much the exact same thing for all the stuff a business owns: their delivery trucks, their computers, their machinery. Over time, they all lose value. So that leads to a really important question, right? I mean, a company can't just buy $1 million piece of equipment and then just ignore the fact that it's slowly becoming less valuable every single year. There has to be an official way to track that loss in value. And that, my friends, is exactly where depreciation comes in. Okay, so what is this thing really? Let's break down the actual definition. Basically, depreciation is just the official accounting system for spreading out an asset's cost over its useful life. How long the company expects to use it. But here's the key, and I really want you to catch this. It's a non-cash expense. That means no actual money leaves the company's bank account. It's just an entry in the ledger, a line item on a spreadsheet. That little detail, it's about to become everything. All right, so if no actual money is leaving the bank, why on earth is this such a big deal? Why do businesses and investors obsess over this stuff? And here it is, the big secret. The number one reason this matters, the whole game, it all comes down to a single word: taxes. So let's look at the basic math here. It's actually pretty straightforward. Your tax bill is based on your taxable income. So if you want to pay less in taxes, pretty simple, right? You got to make that taxable income number smaller. And the way you do that is with deductions. And this is how that magic trick works. Remember that non-cash expense we talked about? That little paper entry? Well, the government lets you count that as a real business expense, which means it's a tax deduction. So even though no cash left your pocket, you get to subtract that depreciation amount from your income. A lower income on paper means you pay less tax in real cash. It's a paper loss that creates real cash savings. Okay, so we get it. We can take a deduction. But how much exactly? Well, there are a couple ways to figure that out. Let's start with the most straightforward one. This first method is called the straight line method. And honestly, the name says it all. It's just a simple, steady, predictable deduction. The same exact amount, year after year after year. Nice and easy. Check out this example. It makes it super clear. So say a business buys a machine for 50 grand. They figure they'll use it for about 5 years and then sell it for scraps for maybe 10,000. That means it's going to lose $40,000 in value over its life. With the straight line method, you just divide that 40 grand by 5 years and boom, an easy 8 grand deduction every single year, just like clockwork. Now, that steady approach is fine and dandy, but what if a business is thinking, how can I save more money right now? Well, that brings us to a whole other strategy. And this question really gets to the core of smart financial strategy. Because, a dollar in your pocket today is way more valuable than a dollar you might get 5 years from now. So is there a way to speed this whole process up and get those tax savings faster? And the answer is a big yes. That's where accelerated methods come into play. Just look at the visual here. The straight line method, that's the gentle, easy ski slope. But these accelerated methods, like MACRS, which is the standard for US taxes, whoa, that's the black diamond run. It's a super steep slide at the beginning, giving you these huge deductions right away, and then it levels off over time. So what's the game plan here? It's simple. Get the biggest tax break possible as soon as possible. Now, to be clear, you're not getting more deductions in total. The total write-off is the same either way. You're just front-loading it. You're shifting the savings to the present and pushing the tax burden into the future. This is a massive boost for a company's cash flow, especially right after a big purchase. Okay, this brings us to one last really interesting piece of the puzzle. If you have these two options, slow and steady versus fast and furious, which one do companies actually pick? And it kind of feels like a trick question, doesn't it? You think you have to pick a lane and stick with it. I mean, can a company really have it both ways? The answer? Yup, absolutely. In fact, it happens all the time. And this is a mind-blowing concept for a lot of people. Big companies basically live in two separate worlds at the same time: the world of financial reporting for investors and the world of tax reporting for the government. This slide breaks it down perfectly. Okay, so for book depreciation, that's what they show to investors and the public. They usually use the straight line method. Why? Because it looks clean, simple, and it gives a smooth, realistic picture of the asset's value over time. But then for tax depreciation, what they show the government, they pull out the big guns. They use an accelerated method like MACRS to get the biggest deductions up front and slash that current tax bill as much as legally possible. All right, so let's boil all this down. What are the big takeaways? 1. Depreciation is just how you spread out the cost of a big purchase over time. 2. Its superpower is that it's a paper expense that saves you real cash on your taxes. 3. You've got options. You can go slow and steady with straight line or fast and front-loaded with accelerated methods. And 4. Companies live a double life, often using both methods at the same time for different reasons. So I'll leave you with this question to think about, because at the end of the day, this isn't just about accounting. It's about strategy. If this were your company, your money on the line, what would you do? Choose the path that looks slow and steady to the outside world, or would you grab the biggest tax break you can right now to have more cash in hand? Your answer says a lot about how you'd run your own business. Thanks for watching.